China's Golden Fortress, the secret plan to end the dollar's reign. Have you ever wondered what might finally challenge the US dollar's reign as the world's financial heavyweight? What if the challenge didn't come from another currency, but from an ancient store of value making a strategic comeback on the world stage, orchestrated by a rising superpower playing the long game? For decades, the global financial system has operated on a foundation of trust in the US dollar and the Western institutions that govern it. International trade, foreign reserves, and the settlement of massive transactions have all predominantly flowed through channels controlled by the West, creating a stable but centralized ecosystem. This system, however, relies on the implicit agreement that access to these financial rails is guaranteed, a perception that has been fundamentally shaken by recent geopolitical events, creating an opportunity for a new paradigm to emerge. China is now actively positioning itself to offer a compelling alternative for large-scale gold purchases, and more importantly, storage that exists entirely outside the purview of Western financial institutions. Beijing is extending an invitation to friendly nations, inviting them not just to purchase gold through the Shanghai Gold Exchange, SGE, but to vault those sovereign reserves within China's own borders. This strategic maneuver is a direct challenge to the long-standing dominance of the London Bullion Market Association, LBMA, and the dollar-denominated gold traded overseas. This initiative is far more than a simple commercial rivalry. It represents a critical event, a potential tipping point in the global financial order. The catalyst was the 2022 decision by the United States and its European allies to freeze approximately $300 billion of Russia's foreign reserves following the invasion of Ukraine. This act, regardless of its political justification, sent a seismic shockwave through the world's central banks, demonstrating unequivocally how financial assets could be weaponized. For nations not firmly aligned with the West, the message was stark. Your reserves are only truly yours as long as you remain in good standing. The immediate impact of this new reality is a surge in demand for assets that cannot be unilaterally frozen or devalued. Gold, the ultimate neutral reserve asset, has become the focus of this strategic shift. Central banks, particularly those in emerging markets, have been accumulating physical gold at a historic pace. Since 2022, official sector gold purchases have consistently exceeded 1,000 metric tons annually, a level of buying not seen in modern history. China's offer to provide secure, sanction-proof storage amplifies this trend, creating a new, powerful incentive for nations to convert their dollar-denominated assets into physical bullion held in Shanghai. The long-term takeaway is that we are witnessing a deliberate and calculated effort to build a parallel financial architecture, one less dependent on the US dollar. China's gold strategy is a cornerstone of this grander vision. By positioning the Shanghai Gold Exchange as a viable competitor to the LBMA, which processes around 90% of global over-the-counter gold trades, China is aiming to chip away at the dollar's dominance in the bullion market. This move complements other Chinese initiatives like the Cross-Border Interbank Payment System, CIPS, an alternative to SWIFT, and the development of the digital yuan. This strategic pivot by Beijing should come as no surprise, as the People's Bank of China, PBOC, has been a primary force behind gold's recent rally. The PBOC has relentlessly increased its own reserves, adding hundreds of tons since 2022 and continuing its purchasing streak into 2025. This consistent buying has been a major factor in pushing gold prices to record highs, recently trading around $3,750 per ounce. Simultaneously, China has been methodically reducing its holdings of U.S. Treasuries, signaling a clear and strategic diversification away from dollar-based assets. This gold-centric strategy is intricately woven into China's broader geopolitical ambitions, most notably the Belt and Road Initiative, BRI. The BRI, a massive global infrastructure development program launched in 2013, has created a network of economic partnerships across Asia, Africa, and Latin America. By offering gold as a settlement and reserve asset for these partner nations, China provides an alternative to dollar-denominated debt, making participation in the BRI more appealing for countries wary of Western financial leverage and potential sanctions. The establishment of a gold custody service in Shanghai is a logical extension of this strategy. For a nation in the global south, the ability to purchase gold on the SGE and store it securely in a Chinese vault presents a powerful proposition. It offers a pathway to enhance monetary sovereignty and insulate a portion of their national wealth from the political pressures of the West. This creates a powerful new source of demand for physical gold, further underpinning its price. However, this offer of financial independence comes with its own set of dependencies. Nations that move their reserves out from under the influence of the United States and into vaults in Shanghai are, in effect, trading one form of dependency for another. They are placing immense trust in Beijing, betting that China's promise of non-interference will hold true. It becomes a calculated choice, aligning with a power that is actively challenging the existing global order rather than the one that currently leads it. The momentum for this shift is undeniable and extends beyond China. The BRICS bloc of nations, Brazil, Russia, India, China, and South Africa, now expanded to include others, is actively working to reduce reliance on the U.S. dollar in international trade. They are developing alternative payment systems like BRICS Pay and increasing the use of local currencies in bilateral trade. This collective push for de-dollarization creates a fertile environment for a gold-backed alternative to gain traction, with China positioning itself as the key enabler. India, a key U.S. strategic partner and BRICS member, provides a compelling case study. After facing punitive tariffs from the U.S. over its continued importation of Russian oil, New Delhi did not capitulate. Instead, it doubled down on its trade agreements with Russia, signaling a clear preference for its own economic and strategic interests over alignment with Western policy. This incident underscores the growing willingness of major global players to chart a course independent of Washington's directives. All these moves are components of China's long-range 2050 vision, a multifaceted strategy aimed at restoring its position as a leading global superpower by 2049, the 100th anniversary of the founding of the People's Republic of China. Unlike Western democracies, which often operate on short election cycles, Beijing has the ability to plan and execute strategies that span decades. This long-term perspective allows for the patient and deliberate construction of the institutions and relationships needed to reshape the global financial landscape. China's leadership can act decisively, without the constraints of public opinion or legislative debate. When an opportunity arises, such as the geopolitical fallout from the freezing of Russian assets, they can move swiftly to capitalize on it. This agility is a significant advantage in the slow-moving world of international finance, allowing them to methodically build their alternative system while the established powers grapple with internal politics and shifting alliances. The Shanghai Gold Exchange itself, founded in 2002, has grown to become the world's largest physical gold exchange by trading volume. Its emphasis on the physical delivery of bullion stands in contrast to the Western markets, which are heavily dominated by paper derivatives and futures contracts. This focus on tangible assets resonates strongly with central banks that are seeking to hold real, unencumbered gold as a core part of their reserves, further enhancing the SGE's appeal. By creating the SGE's International Board in 2014, China laid the groundwork for foreign participation in its domestic gold market. Now, by adding secure custodial services, it is transforming the SGE from a domestic marketplace into a potential platform for global reserve management. This isn't just about storing metal. It's about building a new ecosystem for international finance, with gold and the yuan at its center. The implications for the gold market are profound. We are witnessing a fundamental shift in the drivers of demand. For years, gold's price was often seen as an inverse reflection of U.S. monetary policy and the strength of the dollar. While those factors still matter, a new, powerful, and far less predictable driver has emerged: strategic buying by sovereign nations for geopolitical reasons. This new layer of demand is structural, not cyclical. Central banks are not buying gold for short-term speculative gains. They are buying it as a long-term strategic asset to protect their national wealth and enhance their economic independence. This persistent, price-insensitive buying creates a strong floor under the gold price, absorbing a significant portion of annual mining production and putting upward pressure on prices for all market participants, including individual investors. The current supply of newly mined gold is struggling to keep pace with this voracious demand. Global gold production has been relatively flat for years, and discovering and developing new large-scale mines is a costly and time-consuming process. With central banks locking up a substantial portion of the annual supply, the remaining available gold becomes more scarce, naturally leading to higher prices. The competition between the Shanghai Gold Exchange and the London Bullion Market Association is not just a battle over market share. It's a contest of two different philosophies. The LBMA represents the established, dollar-centric financial order, built on a complex system of unallocated accounts and over-the-counter derivatives. The SGE, with its focus on physical settlement and its backing by a sovereign power seeking to challenge that order, offers a fundamentally different value proposition. For nations participating in China's new system, the benefits are clear. Assets held in Shanghai are shielded from sanctions that could be imposed by Western institutions. This directly addresses the core fear that has driven central banks to diversify their reserves in the first place. The ability to transact in a system that is not subject to the political whims of the US or Europe is a powerful incentive that could accelerate the flow of gold reserves eastward. This shift also has the potential to alter the very mechanism of price discovery in the global gold market. For decades, the London and New York markets have set the global price. However, as the SGE's trading volumes grow and it attracts more international participants, its own yuan-denominated benchmark price will gain influence. This could lead to a more multipolar pricing environment, where the price of gold is determined as much by physical demand in Asia as by futures trading in the West. This entire dynamic forces us to reevaluate our understanding of gold's role in the modern portfolio. It is no longer simply a hedge against inflation or a safe haven asset during times of market turmoil. It has reemerged as a critical geopolitical tool, an instrument in a global power struggle that will define the 21st century. The strategic moves being made at the national level are now a dominant force driving its valuation. The rally that pushed gold to new heights did not wait for the US Federal Reserve to begin cutting interest rates, as many analysts had predicted. Instead, it was ignited by the relentless and strategic buying of central banks. This demonstrates that the demand from the top, driven by long-term geopolitical considerations, can easily override the traditional economic signals that investors have historically relied upon. Therefore, the invitation from the Shanghai Gold Exchange is not an event that will spike the gold price overnight. Rather, it is another significant and deliberate step in a long-term trend. It adds another powerful layer of structural demand to an already tightening market, and provides a clearer picture of how integral gold has become to the broader movement away from a unipolar, dollar-dominated financial world. Looking ahead, we must expect the unexpected. The world of finance is entering a period of fragmentation and realignment. The certainties of the post-Cold War era are fading, and new centers of power are emerging with different priorities and different visions for the future. In this environment, gold's timeless appeal as a neutral, tangible store of value is being rediscovered by the world's most powerful financial institutions. This strategic shift is not about a sudden collapse of the dollar, but a gradual erosion of its dominance. China is not seeking to detonate the current system, but to build a viable alternative alongside it. The offer to custody foreign gold reserves is a key piece of that construction. It provides a sanctuary for nations seeking to diversify their holdings and reduce their vulnerability to financial coercion. As this new financial landscape takes shape, the demand for physical gold is likely to remain elevated. The forces driving this trend, geopolitical competition, de-dollarization, and the desire for financial sovereignty, are not fleeting. They are deep-seated, long-term currents that will continue to influence the decisions of central banks for years to come. The rise of the SGE as a custodial hub will not be without challenges. London's dominance is built on centuries of trust, established legal frameworks, and immense liquidity. Replicating that ecosystem will take time, and a proven track record of security and reliability. However, for a growing number of nations, the geopolitical risks of the current system may outweigh the established comforts of the old one. Ultimately, this unfolding story is about more than just the price of a precious metal. It is about the shifting plates of global power and the future of international finance. China's bold move to become a custodian for the world's gold is a clear declaration of its ambition to play a central role in the monetary system of the future. The steady flow of gold into its vaults is a tangible measure of its success. The transition to a multipolar world will be complex and at times volatile. As nations navigate this new terrain, the demand for assets that are independent of any single government's control will only grow. Gold, having served as a store of value for millennia, is uniquely positioned to fulfill this role. The strategic actions of China and other nations are not just a footnote in gold's history. They are writing a new and compelling chapter. The key lesson for any investor or observer of financial markets is that the game has changed. The macroeconomic models that have defined market behavior for the past generation are being supplemented, and in some cases overridden by raw geopolitical strategy. Understanding the motivations of central banks and the long-term vision of rising powers is now just as critical as analyzing inflation data or central bank interest rate decisions. The consequences of this global realignment will unfold over years and decades, not days and weeks. China's gold strategy is a patient one, built on offering practical solutions to the real-world concerns of its partners. By providing a secure and independent alternative for storing national wealth, Beijing is methodically laying the foundation for a new financial order, one where the shine of gold may prove more enduring than the promise of any single fiat currency.